Hey there, savvy investors and curious minds. Today, we're diving deep into a powerful investing strategy that could change the game for you. We're talking about dollar cost averaging, or DCA for short. Now, I know what you're thinking. Another investing term? Ugh! But trust me, this one's worth your time, and I'll break it down in a way that's easy to understand and actually fun to learn about. So, what exactly is dollar cost averaging? Well, imagine you're at an all-you-can-eat buffet, but instead of piling your plate high in one go, you make multiple trips, taking a little bit each time. That's essentially what DCA is for investing. Instead of dumping all your money into the market at once, you invest a fixed amount regularly over time, regardless of what the market's doing. Now, why would anyone want to do this? Well, let's face it, trying to time the market is like trying to predict the weather in England. It's unpredictable, and even the pros get it wrong sometimes. With DCA, you're not trying to outsmart the market, you're playing the long game. Here's where it gets interesting. When you use DCA, you end up buying more shares when prices are low and fewer shares when prices are high. It's like going shopping and automatically getting more bang for your buck when there's a sale without having to hunt for discounts. Let me give you a real-world example. Say you decide to invest $100 every month in your favorite tech stock. In January, the stock is $50 a share, so you get 2 shares. In February, it drops to $25, so you get 4 shares. In March, it jumps to $100, so you only get 1 share. See what happened there? You got more shares when the price was low, which could potentially lower your average cost per share over time. Now, I know what some of you skeptics are thinking, but what if I miss out on a big market jump? It's a fair question. If the market only goes up, then yeah, you might have been better off investing everything at once. But let's be real, the market doesn't just go up. It's more like a roller coaster, with ups, downs, and sometimes loop-de-loops that make your stomach churn. DCA is like wearing a seatbelt on that roller coaster. It might not give you the biggest thrill, but it helps protect you from the worst bumps and jolts. It's especially great for those of us who get a bit queasy with market volatility. By investing regularly, you're less likely to panic sell when the market dips or FOMO buy when it soars. But wait, there's more. DCA isn't just about managing risk, it's about building good habits. It's like going to the gym. Consistency is key. By setting up automatic investments, you're training yourself to be a disciplined investor. Before you know it, investing becomes as routine as brushing your teeth, but hopefully more exciting. Now, let's talk about the psychology behind DCA, because investing isn't just about numbers, it's about managing our own emotions too. Have you ever bought something expensive and then saw it on sale the next day? That feeling of regret is what behavioral economists call loss aversion, and it's a big reason why many people struggle with investing. DCA helps combat this by spreading out your purchases. Instead of agonizing over whether you bought at the right time, you're buying at many different times. It's like hedging your bets, but with less stress and more consistency. But here's where it gets really cool. DCA can actually make market dips work in your favor. When prices fall, your fixed investment amount buys more shares. It's like the market is having a sale, and you're automatically taking advantage of it. Over time, this can potentially lower your average cost per share, setting you up for better long-term gains. Now, I'm not saying DCA is perfect. Like any strategy, it has its pros and cons. For instance, if the market is consistently rising, you might miss out on some gains compared to investing a lump sum up front. And if you're investing in individual stocks or funds with transaction fees, those costs can add up over time. But for many investors, especially those just starting out, or those who get nervous about market swings, the benefits of DCA often outweigh the drawbacks. It's a way to stay invested and keep growing your wealth without losing sleep over every market hiccup. Here's a pro tip. DCA works great with index funds or ETFs that track broad market indices. These give you instant diversification, and when combined with DCA, you're essentially buying little pieces of the entire market over time. It's like building your own personal economy, brick by brick. So how can you get started with DCA? It's easier than you might think. Many brokers and investment platforms allow you to set up automatic investments. You can start with as little as $25 or $50 a month. The key is to choose an amount you're comfortable with and stick to it. Remember, investing is a marathon, not a sprint. DCA is all about playing the long game, staying consistent, and letting time work its magic. It's not about getting rich quick. It's about building wealth steadily and sustainably. As we wrap up, I want to remind you that while DCA is a powerful tool, it's not a one-size-fits-all solution. Your investment strategy should always align with your personal goals, risk tolerance, and financial situation. If you're unsure, it's always a good idea to chat with a financial advisor. So there you have it, folks. The ins and outs of dollar cost averaging. It's a strategy that can help you navigate the choppy waters of the market with more confidence and less stress. Whether you're a seasoned investor or just dipping your toes in, DCA is definitely worth considering as part of your investment toolkit. If you found this video helpful, don't forget to smash that like button and hit subscribe for more investing tips and tricks. And hey, drop a comment below. I'd love to hear about your experiences with DCA or any questions you might have. Remember to turn on those notifications so you don't miss our next deep dive into the world of investing. Until next time, happy investing, and may your portfolio always be in the green.